Hello everyone, I am Misk and I am a practitioner of market structure, and my main focus in trading is futures. Now, what exactly is futures? Well, futures can be used as a broad term for what exactly I trade. What I mostly focus on is indexes, and the indexes that I focus on is the Nasdaq, the Dow, and the SPX 500, which most commonly are what people refer as futures, as they are the exchanges through which the New York Exchange or the New York session moves with. If we see Nasdaq, the Dow, and the SPX 500 moving a certain direction, the entire market will sympathize with the movement that they are doing. Now, how do they work? Honestly, they work as the same way as any stock, the same way as any currency. We have the price action that it does and the movement it does heading towards the direction that the central banks or the market makers want the price to go. When it comes to the comparison, however, between trading futures and trading stocks, there is a very noticeable difference that I would say. The primary difference is that futures, or these huge indexes, are manipulated through the central bank, or what I would consider the market makers. They are manipulated in the sense that they send constant signals to institutions and banks to follow them with every order that they make. In this way, they are perfectly able to control the price in whichever direction they want. Much easier to track, much easier to trade, and much easier to predict. However, stocks, depending on several factors, if they are a mid cap, a small cap, or a blue chip, a large cap, they can be manipulated by different parties. And what I mean by this is, if we were to look at Microsoft, Microsoft is not a stock that can be manipulated by just anyone. They can be manipulated by institutions, banks, and market makers, the central bank. Those are the most common ones that manipulate these big entities, and they all do it together through a various amount of signals. But if we were to look at mid caps, small caps, penny stocks, anyone with the right amount of capital can manipulate the movement of these stocks. So when it comes to how predictable something can be, I would say that futures tend to be more predictable than stocks. And this is why I personally moved from trading options and stocks to trading futures, because it was much easier to track the manipulation from one entity than the manipulation from several entities that could have a range of effects on one stock. So that's what I would, in my opinion, compare when it comes to futures and stock trading. Now, regarding how to profit from futures, it is not as different as how to profit from stocks or from options. When the price moves a certain amount, you make a certain amount of gains. However, in this case, when we look at futures, our gains are not based specifically on a dollar amount, or in options, on Greeks. Our gains in futures are based primarily on the amount of points that the indexes move by. And what I refer to by this is, if we enter a short position here and the Nasdaq drops all the way here, That is a move of 173 points, which would in total be $175 of profit per every 001 lot you have of Nasdaq. A comparison of options to profit, you would need the Greeks, which would be the delta, the theta, the IV, the volume, and the open interest. All of these kind of mixed in together. But the perfect thing about trading futures is that there's always liquidity. It is never an issue, and it is something that makes going in and out as smooth as you could imagine. Regarding what platforms I use to trade futures, I use a broker called Osprey. However, when it comes to FX brokers, they are most commonly connected to an application called MetaTrader. MetaTrader is where we will execute our trades. However, the broker will be Osprey FX. We can also trade futures in a certain amount of other brokers like Thinkorswim, E-Trade, or TradeOvat. However, in these kind of brokers, we may experience a different kind of futures. And I don't mean that we have to look at different charts. I mean that the buy and sell happen to be by contracts, similarly to options, with the only difference that there are no Greeks. We only profit by the amount of points the NAS or the index that we're playing moves by. Now, I would like to indulge into an idea, which is my trading style. My trading style is a concept known as market structure. This is what led me to become, from going from an inconsistent trader to a consistent trader, to the point that I was so consistent and so successful that I have been able to adequately have a very high win rate in every single one of my plays. It has reached a point that I could say that I am capable of, in the span of the next coming months, to reach financial freedom just by this skill alone, or this concept that I have embraced. Now, what exactly is different between market structure and something like retail trading? It is simple. The main idea that separates the two is that market structure is based on tracking the movement the market makers are doing and playing alongside them. Now, this is all of my opinion, right? Everything I'm about to say regarding market structure is my personal opinion regarding how I felt and regarding how I've traded. So with that being said, market structure main objective is to track the movement market makers are doing, to predict them, and to play alongside them. While the difference is that retail traders, they use patterns, indicators, flow, volume to try and predict where the price is going, with the ideology that the ones that move the markets are the bears and the bulls, when in reality, in my opinion, it's neither. It is the central bank, the market makers that move the price, and it will always be them. They just play their game towards the retail. Retail thinks that patterns work, I think they don't. I think they are flawed and they're useless. Retail thinks indicators work, I think they are flawed and they're useless. Retail thinks that by relying on flow, they are seeing where the smart money is moving. I think the flow is heavily manipulated and used to send signals to banks and institutions on where they should enter and not, and trick retail traders with that. I believe everything we are seeing in retail trading, and these concepts are setting people up to failure. I believe that these concepts are the reason only 95% of traders, only 5% of traders are successful, while the other 95% are failures. Because they aren't taught the correct knowledge, in my opinion. And what could you consider correct knowledge? The knowledge that makes you think outside of the box and realizes that what we are doing is playing against the market makers every single time, unless we focus on the bigger picture, which is market structure. And that is my opinion. And the reason I say this is because we could wake up at any moment of the day, and with market structure we can predict exactly where the price is going to go without needing any of the previous things mentioned in retail trading. And what I mean by that is an example of today. Today, using market structure, if I had started the day around how I usually do, after market open, what we see is a huge candle to the downside. Now, what common retail traders could think is, oh, this is the support, we just hit the support, we failed to break the support, so we're most likely going to bounce upward towards where? Probably the resistance. Let's look at the 5 time frame. Probably here. Around here was where we're going to go. But according to market structure, what we are going to see after this bearish imbalance, that's what we're going to call it, a bearish imbalance, is a retracement towards this fair value gap. Right? Not only are we going to see a retracement to the fair value gap, but let's get our 1 hour. We are going to see a push to the downside to the sell side liquidity. In fact, we just saw it with that bearish imbalance. It purged the sell side liquidity, so technically this is useless to us. But instead, we have over here another sell side liquidity, which we are going to keep in mind for later. And the reason we're going to keep this in mind is because this is exactly where the market makers are going to push the price to. Here, and potentially here. Now we go back to our 15-minute time frame. We see the structure the market has heading towards 10 p.m. So what I expect from here is that we are going to purge the sell side liquidity that's right around here. And what happens? What we witness is, so what I can expect is that we're gonna hit the sell side liquidity throughout the day. And the reason for that is because we made a fair value gap to which the price, after hitting the first sell side liquidity and purging it, is pushing upward to fill. Now, how can I tell that from this movement we are going to drop and purge the sell side liquidity? Simple. Because this movement right here is about to confirm a bearish order block that will send us to the sell side liquidity and send us to fill the fair value gap. Right here, we confirmed our bearish order block, which in exchange turned into our new buy side liquidity. Now we will keep that in mind for future reference in case the price ever wishes to re-challenge that. common in market structure by market makers is that huge candle we just witnessed, that huge imbalance. Now what this is commonly known as a liquidity attack. Retailers often call it a knife up, knife down. But what it really is imbalances or liquidity attacks that force people out of their positions. People enter here, they put their stop losses. They're in profit, they raise their stop losses. Bears enter here, they're at break even, maybe even red. They put their stop losses a bit high. Everyone puts stop losses to try and play the play securely. What happens? The liquidity attack purges all of their stop losses. So everyone in these positions are now sold out. They have sold for a loss, for a gain, but they have sold, and that created liquidity in the market, which is what market makers love. And afterwards, instantly we see a price drop down. Another liquidity attack, but this time to the downside. Why? Because all of the bulls that got in here thinking we were breaking out to the upside got trapped, and now their stop losses are triggering, creating more liquidity. Beautiful thing around here, if we looked at the 3 minute, was in fact that right here we created another imbalance followed by another fair value gap that after hitting buy stops we created another bearish order block that drove the price lower, where precisely the sell side liquidity. We don't have to play by support and resistances. We know where it's going. It's going towards the sell side liquidity, which in this term be this line around here. Around there. Another bearish imbalance is made. Price is driven lower. So what happens here is a higher time frame retracement. Why? Because we just, as we push the price down and create a bearish order block, we create another buy side liquidity. Now in this scenario, this buy side liquidity needs to be purged so that the market makers have more liquidity to drive the price lower. Now how do we know that the price from here is going to go back here? Because we're witnessing bullish order blocks at the very low of these candles. We have one confirming, aiming us to the upside. There we have it. Our bullish order block got confirmed and purged buy side liquidity in smaller time frames, which was probably around here, retraced, confirmed more bullish order blocks right there, drove the price higher until it purged the buy side liquidity. And the moment they purge the buy side liquidity, market makers have an algorithm that places unimaginable amount of orders to sell. To sell where? So that the price is driven downwards. Where? To the sell side liquidity that they desire to purge. And that's what we're going to witness right now. Heavy bearish imbalances. The moment we purged this buy side liquidity, we created a bearish imbalance after bearish imbalance. And that's not all. We created bearish order blocks right there. These bearish order blocks And these bullish order blocks are the movements market makers use to shift the price. And where exactly did we hit after we purged the sell side liquidity? We hit a fair value gap in the hourly time frame. So what can we expect? Well, we just hit a fair value gap. We have a bearish imbalance to the downside, so we have a new fair value gap. And what we can expect is that the price is going to try and fill this fair value gap and attempt to create a bearish order block to drive the price even lower. This is my style of trading. I focus on the movement the market makers are doing, and I focus in following them and trading them around. This is a brief introduction of what I do, a rushed up introduction of what I do. However, the accuracy that I've had when doing it has been impeccable. This entire month I have not met defeat, and I doubt that I will ever be seeing consistent defeat as I used to when I traded options. I think that this ideology, additioned to trading futures, is what will most likely change my life for the better, and in a way that I have never foreseen it. This is my introduction to futures, as well as a brief introduction to my trading style, which is market structure, and how I implement it every day to predict where the market is going, regardless of news, flow, patterns, or indicators. I hope you all enjoyed this session. I can't wait to catch you guys around.